So for today's Market Rant, we're going to be talking about Uber and ride sharing. So as some of you might know, Uber made their public debut on Friday. And as I expected, it did not go well. Their competitor in this space, Lyft, went public last month. And even though they did have a strong IPO performance, the stock has really struggled since then. And I think they're down about 30% since their IPO debut. Now, these were two public debuts that I had, frankly, zero interest in participating in. Actually, let me check the math on that. One. Yeah, that's right. Zero interest in participating in. And the reason for that is simple. They don't make any money. And that's not so much the problem as them not making or me not believing they're going to make money anytime soon. The core mobility platform that these companies are built on is an obscenely unprofitable business. These companies are losing billions of dollars every year. Actually, Lyft just reported their first quarter earnings report. I believe it was last week. And they reported that they lost $1 billion in the first quarter alone. That is $1 billion in 90 days, okay? I didn't say they spent $1 billion in the first quarter. They legitimately, on a revenue basis, lost $1 billion in 90 days. That is just absurd. And they've sort of been given the freedom to just go and burn through billions of dollars in cash because it's this belief that they need to grow their network to really become profitable. And here is why that is. When Uber and Lyft would go and pitch their company to investors in Silicon Valley or in Wall Street, they would say that their path to profitability hinges on this thing called the network effect, which is really just a buzzword at this point in time. All it means is that the more people who are on their platform, the more people are going to want to be on their platform. And as they continue to grow and grow and grow and grow, they get to a point where they've achieved sustainable pricing power. They can use that to jack up margins, and then bang, they're profitable. But as we've seen with these companies, it's continuing to grow their platform and add more drivers and riders and increase their revenue. That has not happened. As they've continued to grow their revenue, I think Uber is now making $12 billion a year in revenue. Their losses have continued to widen, which indicates to me that there is virtually no demand side economies of scale in this business versus a company like Beyond Meat that went public about 2 weeks ago. Even though they are losing money, they're continuing to grow their revenue and their losses at the bottom line are shrinking. That is not the case for Uber and Lyft. So now what they're saying is their path to profitability is going to depend on autonomous vehicles. And it makes sense because, of course, I think it's 70% of their costs are the drivers. And so if you get rid of the drivers, you can keep more of that cost for yourself. But the fact that that is what they believe is the key to their path to profitability is probably the biggest reason why I'm bearish on both Uber and Lyft. And here's why. It's actually a lot of different things. So first of all, autonomous vehicle technology is not going to be market ready for at least another 3 to 5 years. At least another 3 to 5 years. And even when we've perfected the technology and are able to deploy it en masse to the market, it's going to take years for consumers to be comfortable with that kind of technology. Do you expect that the second self-driving cars roll out, customers are going to be like, oh yeah, here's a robo-taxi coming to pick me up and take me to, I don't know, the mall. Let me just hop in and just get going. That's probably not going to happen for several years. And even when that happens, on the driver's side of things, the idea that they're just going to be able to eliminate 5 million people's jobs, just get rid of 5 million drivers without there being riots and lawsuits and Senate investigations and just horrible PR blowback is also just absurd. They're not going to be able to just lay off all these people and replace them with robo-taxis without there being at least considerable public blowback. So more than likely, because of those two things, they're going to have to really elongate the rollout of their autonomous vehicle program. And because of that, it's going to delay their path to profitability. Aside from that, even when they've been able to roll out this autonomous vehicle program in mass to their consumers, all of a sudden, once you start playing or transitioning from the gig urban mobility platform that they're currently based around to this robo-taxi model, it's no longer a duopoly between Uber and Lyft. Now you're competing with Google's Waymo, with GM's Cruise, with Tesla, companies that are also investing billions of dollars into building out this sort of robo-taxi network. And these are companies that, aside from Tesla, are very well funded, have tons of talent and intellectual property, that it's not going to be easy for Uber and Lyft to dominate that industry the way they're dominating ride sharing today. So to sum it all up, Uber and Lyft are two shit companies in a shit industry. Lyft is by far the shittier of the two because they have nothing to fall back on but this urban mobility rideshare thing that, as I've explained, is not a very profitable business. Uber is a little bit different. So Uber is also shit, don't get me wrong, but they're sort of shit wrapped in cotton candy, right? So there's good things there too to sweeten the whole pie. You got Uber Freight, which is essentially Uber's idea of building into a high margin, profitable freight business using the current assets that they have. That has potential to be profitable. But let's not make any mistake here. Nobody's buying Uber for freight. And then you have Uber Eats, which on its own I think is valued at about $30 billion. Now, Uber Eats is a profitable business. That is cotton candy. But as an investor, why would I eat shit to get a taste of cotton candy when I can just kind of eat cotton candy? You know, there's pure play in the food delivery industry like Grubhub that's doing pretty well on their own without having this unprofitable business model behind them. You know, one thing you got to think about too is that if it's going to take 10 to 12 years for these companies to become profitable, what happens when the economy takes a downturn? Are investors going to be willing to keep throwing money at an unprofitable business like Uber and Lyft? Maybe, I don't know. My guess is they're going to be a lot less inclined to be throwing money into cash burning businesses than they will be when the economy is doing good as it is now. So that's my take. I've got no interest in investing in Uber or Lyft anytime soon. But if anyone on there is listening, if you paid attention, let me know what you think. If there's anything you guys are looking